Welcome to Fear and Greed, the week ahead. This is where we take a look at the big events, reports and releases coming up this week that gives insight into the economy and a look back at what happened last week too. I'm Sean Aylmer, and every Monday I'm joined for the week ahead by economist Stephen Koukoulas. You'll find him at thekouk.com and on Twitter using the handle thekouk. And just in case you don't know how to spell that, TheKouk, the Kouk. Stephen, aka the Kouk, good morning.
Good morning, Sean, SEAN.
That's exactly right. Now, let's think about last week. There wasn't exactly a lot of data around last week relative to the week before, but what did come out was pretty interesting. And if we start with the Business Conditions Index, the NAB index, things are looking pretty good, including CapEx.
Another good result from the NAB business survey. You know, when you see a 1 month spike in some of these indicators, you think, well, it could just be a timing issue or just a little bit of a quirk. But this really reinforced what we've been seeing for the last couple of months in the NAB survey, and that is really strong optimism about the economic outlook. As you said, both confidence and business conditions, while they sort of went up and down a couple of points, they're still at extremely high levels. The CapEx expectations, so the business investment climate, is extremely positive, and that feeds back into the other indicator that doesn't get a lot of attention, is capacity utilisation. It's extremely tight at the moment, so firms are sort of telling the NAB when they do the survey that conditions are good, that they're running at full capacity, that they're going to have to increase their business investment plans for the next 12 to 18 months. And also within that, hiring intentions are pretty good. So that labour market recovery that we've been seeing is probably going to continue for at least a few more months.
Okay, now there was some weaker economic news last week, albeit not exactly weak, the consumer sentiment data, because that's fallen for a couple of months in a row now.
Yeah, it eased off again. The fall 2 months ago was after a near record spike in consumer sentiment. So that one was largely discounted. This one, another 5% approximately fall in sentiment. They put it down partly to the Melbourne and Victorian lockdowns. Even though the survey was conducted early on in that lockdown period, there was still probably some impact there. But again, it's just a little bit more of a pullback than perhaps you'd like to see. These things are, again, very choppy, very volatile month to month. And, you know, who knows, could be because Collingwood lost or something like that. But I'm not sure. But, yeah, but the sentiment numbers are very fickle. But you'd prefer it to be sort of trending at a higher level than we actually saw in the most recent month. Nothing to worry about yet, but the next couple of months will be interesting, to say the least.
And the ASX is doing very well. Like, yet another record high last week. Investors are pretty confident at the moment in that whole switch to value stocks away from growth stocks. What do you think of that?
Oh, look, there's something there in that. Again, if you think about, and I know a lot of people don't think that the real economy is the stock market and vice versa, but I've been around long enough to realise that businesses do well. They make money. They increase their earnings. They increase their profits when the economy's strong. You know, we all know that stock markets tend to really fall away in a recession. And indeed, this time last year, when the COVID issue came along and we thought the recession was going to be long-lasting and particularly deep, that the ASX fell below 5,000 points. So here we are at the end of last week, 7,300 or thereabouts on the index, on the ASX 200. Investors are confident about the outlook. Interest rates are going to be low for a little while longer. Businesses are making money. There's a bit of M&A activity going on as people and investors look for an opportunity out there. And you look at some of the share prices today on where they were beaten up a year ago, and some of the gains are phenomenal, 100% plus.
Sure. Stephen, that's last week. We'll be back in a moment and get into the week ahead. Stephen Koukoulas, big week this week for the labour market. The May labour force figures are out.
A huge number. I know we say that every month when the labour force numbers come out, but they are really important. They're the benchmark that the RBA and even the government have set themselves to achieve that full employment. You might recall that a few months ago, they wanted to get that NAIRU, the full unemployment rate, down below 5%, towards 4.5% before they would consider doing anything on official interest rates and repairing the budget. So each month we get an update. This is the second month post-Job Keeper ending at the end of March. It's likely to show a bit more of a softer result because of that. But nonetheless, I don't think anybody's realistically expecting the unemployment rate to be moving higher. So what I think the consensus is for a small increase in employment, about 10,000, unemployment to hold around 5.5%. But with these job ads and vacancies still rocketing along, it's just probably more a statistical quirk from the ending of JobKeeper rather than a change in trend. I still think we're on track for a sub 5% unemployment rate late this year or early 2022.
Now, Phil Lowe, the Governor of the Reserve Bank, is also speaking this week. Do you think there's any chance of him changing his tune about what you've just been talking about?
Yes, I think there is. I think he's going to soften up the market. Not that it's going to be a surprise anymore, because lots of people are talking about it, how they're not going to extend their yield curve control policy, and that is moving from the April 2024 bond purchase, which is the one which they're targeting at 0.1%, and moving it to the November 2024 bond and targeting it at 0.1%. So what that means is that the RBA is saying that, look, we are happy with the economic performance that we're seeing. We're not quite there in terms of achieving our full employment goal and achieving our wishes for wages to pick up and, of course, for inflation to get back within the target. But we do not need to extend our bond buying purchases beyond the early 2024 period, because that's when we think, the Reserve Bank, that's when we think that we might need to be tweaking interest rates up. So he'll probably paint a positive picture. He'll be pleasantly surprised by what he's seen compared with what they were forecasting even a couple of months ago. And so just setting the market up for, okay, it's time to start considering that this stimulus that's in place probably is getting close to its use-by date.
And in a very practical way, what does that mean? Does that mean that the 3, 4, 5-year fixed mortgage rates are likely to start creeping up if he comes out and says that?
Yes, indeed. And in fact, it's already happened a little bit. We've seen a couple of the banks tweak up their 3 and 4 year fixed rate products by 10, 15 basis points. So nothing dramatic. And again, it's not going to change a huge amount the mortgage market in any material sense. But if he does come out and signal that, then that backup of yields out beyond the 3-year part of the yield curve means that the pricing of those mortgages, which the banks use the swap market, which is based on government bond yields, will creep higher in yield. So while not in the business of recommending mortgage rate fixing or floating or whatever you've got for your mortgage, in fact, far from it, it'll be interesting to see that I suspect we're at the early stages of a bit of a correction higher in terms of yields in the retail mortgage market. Even though the RBA is keeping official rates steady, its actions on that yield curve control means that some of those fixed rate products might start creeping up higher.
Well, Stephen, I've got to tell you, only last week I actually refinanced my mortgage and I went 50% variable and 50% 4-year fixed, basically on your argument. And I'm certainly not here to argue one way or another. I've sort of hedged my bets by going 50-50.
Yeah.
But I mean, it's sort of something to think about. I think that fixed rates will start rising.
Well, I think the safe thing to say is that rates aren't going to go any lower. And okay, we might be in for an extended period, and that extended period could well be 2, 3, and even 4 years. If we have a bit of a hiccup in this economic recovery, the RBA is not going to hike. So all we're talking about is whether rates stay this low for many, many years, or whether with good economic news, and I think we've argued in recent weeks, if we do get a pleasant surprise and the Reserve Bank is forced to hike early, it'd actually be a good thing because it means the economy is doing well.
Yeah, exactly. The other bit of data around is the March quarter house prices. That's the official ABS numbers, but we sort of know what's in those already because of other providers.
Indeed, we do. This is March quarter, so we've already got the CoreLogic numbers through to the end of May, so we know what happened more or less. And look, they're the official numbers. They're a slightly different methodology to CoreLogic. There's a bit bigger sample size, so they're the official numbers too. Everybody likes to get what the ABS is saying, and it looks like, from what we know from CoreLogic, that in the quarter, house prices nationwide were probably going to be up around about 5.5%. Wow. Sydney probably up about 6.5%. This is just a quarterly number, don't forget.
Yeah, incredible.
And just really, we'll get a few headlines, no doubt, in the middle of this week about house prices still going gangbusters.
Yeah, okay. Just one other figure that comes out, we don't normally talk about it, but it is interesting at the moment. That's the population data, because normally we're growing in population, but we're not at the moment.
Yeah, the demographic data, the population, of course, has been such a pivotal thing for the Australian economy for many decades. We could even say, 240 odd years. But certainly the last 20 years, we've had high levels of immigration. It's fueled demand for housing and infrastructure needs and these sorts of things. So we know that with the international borders shut, the last quarterly numbers that we saw, population actually fell. We had a few more people leaving than arriving, and that has implications for the potential rate of GDP growth, some of the demand drivers of the housing market. And so, look, I'm sure a few people will glance at the population numbers to see whether we've had another net outflow of people. It's just a curious quirk when we're trying to sort of work out what the potential for the Australian economy is in an era where we don't have much, if any, immigration.
Now, I've got to let you know, Stephen, I went to the races. I went to Randwick on Saturday, and I actually had a few wins. Now, I've followed your horses previously and haven't had many wins, so I did it myself, based it on my children's names, and actually I think I did better than your tips.
Look, that's probably a very good methodology. A share of a horse is a very, very binding thing. You always think it's going to win. And alas, it hasn't happened. So congratulations.
You tell your friends sometimes too.
I'm not even going to tell you that one of them might be running next week. So,
right.
But that's a good methodology. Well, sometimes people just use numbers or colours or the name of the jockey, and each of those methods is just as good as the other, in my view.
Fair enough. That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.